Chapter 5 is all about special journals, so we need to figure out what the point of them is for. So at this point, here's our accounting process. We've got our transactions happen, and we've been putting them in the general ledger in our T accounts. And what we've been doing is then a trial balance to make sure our debits equal our credits, and then making a balance sheet and an income statement as our financial reports. So just looking at it, we've been entering every single transaction in the general ledger. So taking a cash at bank ledger, because there's so many transactions that affect it, you can see each month there's going to be a lot of items get entered individually. So that's not ideal. We're going to sort of enter everything for each transaction on its own. It's going to be a lot of work. And basically every transaction has three things that we record: a date, a detail, and an amount. That's 54 chances to make a mistake. I think more importantly, there's a lot of bulky detail there. We looked at understandability in chapter 1 and said, can someone comprehend its meaning? I think looking at that ledger, how much cash did I get this month? I can't tell that very easily. I can't tell how much I paid. And most importantly, I can't tell what my final bank balance is. So I think that's really the most difficult thing about entering transactions individually into the ledgers. So if I was to balance that, it is quite a bit of work to figure out the final balance of 7686. So what we're going to do is add in an extra step in between steps 1 and 2. So we'll move the transactions over here, and we'll actually add in a new step 2 called special journals. What we're going to do is add transactions, record them individually in our special journals of the cash receipts journal, cash payments journal, the sales journal, and the purchases journal. When we've entered them all in there, we'll then put them in the ledgers, and then we'll continue the procedure as we were doing it previously. So here's the cash receipts journal. So what I'll do is enter each transaction individually. So these are the transactions from the cash at sale ledger, cash at bank ledger, and then I'll total them up. And so in this case, I've got a total bank column of 6260. So what we'll get in the cash payments journal is all the money I've paid. So in this case, here's all those credits that were in the cash ledger, and we'll get a final total of 3,700 down here. And the whole point now is, instead of having them all listed individually there in the ledger, what we'll do is just start with the opening balance, and then we'll add in this case, we received $6,260. I'll just add in the debits there. And I paid from my cash payments journal $3,700, so I'll take that out there. So now I can answer the question, how much money did I get this period? I got $6,260. How much money did I pay? I can see that easily. It's $3,700. And most importantly, I can now balance this quite easily. I can figure out the total debits there, transfer that number over, and then subtract away the difference to figure out a total balance going forward of 3,760. That's much more understandable. It's much more efficient. And we want to look at some of the advantages when we get theory questions about this. Why are we doing it? Well, one reason is we're getting rid of the bulky detail from the general ledger. The detail of each transaction is important, but we're not going to put it in the ledgers anymore. We're going to put it in the special journals. Much easier to balance, obviously, we just saw that. And each type of transaction can just be posted as one overall figure rather than as many individual transactions.